Imagine it's 14th of July, 2008. You're a 70-year-old retired teacher living in Pasadena, California, United States. You spent decades waking before sunrise, grading papers at the kitchen table, and putting away a little money each month. You did this because retirement in your world was not a dream but a duty. Your savings sit at IndyMac, split across 5 accounts because you were told that spreading the money around would keep it safe. The house is modest, the car's old, and the number on the deposit slip matters more than almost anything else. That number is medicine, groceries, property tax, and the quiet promise that you will not become a burden to anyone. On most mornings, the bank is just a building you pass without thinking, like a bridge you cross without wondering who inspected the bolts. But this morning, before dawn, you are already standing in line outside the branch. The line is long enough to tell you that something invisible has just become real. If you have ever wondered why people trust deposit insurance so completely, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before in different countries under different laws, and each time it reveals the same uncomfortable truth. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. The man in that line was real. His name was Charles Tengery. Reuters reported that he arrived at 4 a.m. at IndyMac's Pasadena branch. When he came back out, he had withdrawn $171,000, about 2/3 of what he believed was safely his. He had $236,000 spread across 5 accounts. He thought that meant safety. The bank and the rules said otherwise. That is the heart of this story. Not that the FDIC is fake, not that banks always fail, but that many people imagine the FDIC as a steel vault around their life savings, when in reality it is a much narrower promise. It protects certain deposits, up to specific legal limits, in specific ownership categories, when an insured bank fails. It does not promise that every dollar you keep at a bank is covered. It does not promise that access will feel normal. It does not promise that all failures will be small, isolated, and neatly resolved over a calm weekend. And it does not protect purchasing power if inflation, devaluation, or capital controls strip away what those dollars can actually do. People hear one phrase over and over: no depositor has lost a penny of insured deposit since the FDIC was created. That sentence is true. It is also incomplete. The key word is insured. Charles Tengery did not lose money because the FDIC failed to follow the rules. He lost money because he misunderstood where the rules stopped. And history is full of people who made the same mistake. Some trusted the limit, some trusted the bank, some trusted the government, some trusted the idea that access to money and ownership of money were the same thing. They are not. They never have been. Before we go further, there is something important to understand. Most people picture a bank account as a locked box. That is natural. It feels true. You log in, see your balance, and assume your money is sitting there like a coat in a closet. But a bank is not a closet. It is more like a theater coat check. You hand over your coat, get a claim ticket, and trust that not everyone will demand their coat at the same moment. The system works because most people do not show up at once. That is what deposit insurance really sits on top of. Banks take short-term money and invest it in longer-term loans and securities. That is a mismatch. A mismatch is when the timing does not line up. The bank owes you now, but its money comes back slowly. The FDIC was created in 1933 after roughly 9,000 American banks suspended operations between 1930 and 1933. In the March 1933 bank holiday, Americans could not freely use banks for about a week, and some 4,000 banks never reopened. Deposit insurance began on 1st January 1934 with coverage of just $2,500 per depositor. The FDIC was born because people learned the hard way that a bank balance is a promise before it is cash. That promise matters. But it has edges. The FDIC says standard coverage is $250,000 per depositor, per bank, per category. That sentence is doing a lot of work. If you misunderstand even one of those pieces, you can think you are safe when you are not. Even when you are insured, the FDIC's goal is to restore access as soon as possible, often by the next business day. That is fast by the standards of panic. It is not magic. Some accounts need more documents. Interest stops at failure. Outstanding payments can be disrupted in a payoff. The deposit insurance fund itself is not a giant warehouse holding one full dollar for every insured dollar. At the end of 2023, the fund held $121.8 billion against about $10.6 trillion of insured deposits. That is a reserve ratio of 1.13%. That sounds shocking until you understand the design. Insurance works because not every house burns down at once. The danger begins when people forget that. This brings us directly to IndyMac. In July 2008, IndyMac was not some tiny village bank nobody had heard of. At failure, it had about $32 billion in assets and $19 billion in deposits. It had branches, branding, and online access. It had the respectability that makes savers lower their guard. Then confidence cracked. After a public letter in late June raised concerns, depositors pulled $1.3 billion in just 11 days. That is what a run looks like. Sometimes it is just many people quietly deciding that being early is safer than being polite. On 11th July 2008, regulators closed the bank and the FDIC stepped in. Insured depositors were protected. But the limit then was $100,000 for many accounts, not $250,000. People tend to remember today's number and project it backward. At IndyMac, uninsured depositors were initially given access to only 50% of their uninsured funds. The rest became a claim on the wreckage. That sounds technical, so let us make it human. Charles Tengery was a teacher. He thought 5 accounts meant 5 layers of safety. They did not, because he was still judged as one depositor. Reuters also quoted Robert Clark of Glendale, who had $360,000 and believed listing family names on the account protected him. He was not. Dr. Jitesh Patel took a day off work to pull his money out and told Reuters he wished he were more savvy. That word matters. Savvy. Not because these people were foolish. They were normal. They had done what normal people do. They saved. They trusted a regulated institution. They assumed the legal plumbing matched the simple story in their head. But banking rules are like ice under snow. The surface looks smooth until your weight is on it. CNBC coverage captured the mood better than any spreadsheet could. Hundreds of people stood in line. Fear was visible, but quiet. People were talking about bills, about retirement, about whether a lifetime of caution led them to the same cliff. Charles Tengery said tellers led him to believe the money was safe if he split it into smaller pieces. What he discovered, too late, was that slices of the same pie are still the same pie. Deposit insurance solves one problem, but people often ask it to solve 3. It can help with legal loss on covered deposits. It cannot erase confusion about ownership. It cannot fully protect money above the limit. It cannot stop panic changing behavior. In a system built on confidence, misunderstanding is dry timber. One spark is enough. There is another detail people miss. The FDIC later said IndyMac's assets were insufficient to make any distribution on general unsecured claims. In plain English, once you move beyond the insured perimeter, hope depended on what could be recovered from a collapsing balance sheet. When people say the FDIC protects depositors, the careful version is this: it protects insured depositors, and does so extremely well. But if your mental picture is broader than the law, the gap between the two can swallow years of savings. When you hear the word safe, do you mean legally covered, or do you mean that you can actually use it under stress? Drop your answer in the comments. Seriously. Because what I am about to show you next changes everything. Look at what happened in Europe. In March 2013, Cyprus became the warning label that many depositors still refuse to read. The country built a banking sector too large for its economy. That is like building a roof too heavy for the walls beneath it. When losses mounted, there was no painless way out. Someone had to absorb the hit. Officials floated a one-time tax. That meant even smaller depositors would be touched. The idea caused outrage. Banks shut their doors for 10 days. When they reopened, capital controls were imposed. These are limits on moving your own money. The account may still say you own the funds, but the road out of the account has police on it. Final structure protected insured deposits up to €100,000. But above that line, the story changed sharply. At Bank of Cyprus, 47.5% of deposits over €100,000 were converted into equity. Large depositors became shareholders. At Laiki Bank, insured deposits were transferred, but most uninsured deposits were left behind in what people call a bad bank. Those depositors ultimately received about 6 cents on the euro. Think about what that means in lived experience. You run a small business in Nicosia. Payroll is due. Suppliers are waiting. Your money is turned from water into ice. It is there, but not in a form you can drink. That is a different kind of loss. It is a loss of time and trust. Many Americans dismiss this because it happened elsewhere, but the human mechanism is familiar. When banks cannot meet promises without support, the language changes. You hear words like resolution, restructuring, and haircuts. A haircut means a forced reduction in what you get back. The brochure disappears. The emergency manual comes out. 2 years later, Greece offered a related lesson. On 28 June 2015, Greek authorities imposed a bank holiday. Banks stayed shut until 20th July, and cash withdrawals from ATMs were limited to €60 per day per card. Online banking inside Greece still worked, but your account balance and your freedom to use it had split apart. In crisis, they divorced in public. People imagine the danger as total disappearance, as if the only bad outcome is a 0. History is less theatrical and more cruel. Sometimes the balance remains on paper while access shrinks and rules change around you. Collapse is not always a fire. Sometimes it is a hallway slowly filling with water while the exit signs still glow. In the United States in 2023, the lesson was not that the FDIC failed, but that the promise was not enough for the new system. Silicon Valley Bank closed on $10 March 2023. At year end, more than 94% of its deposits were uninsured. On 9th of March alone, customers withdrew $42 billion. The speed matters. This was phone speed fear. Group chats and social media posts turned concern into a stampede. Reuters reported founders were scrambling to make payroll. Dean Nelson said access to cash is the biggest problem. Ashley Turner said her heart stopped when the website failed. Under standard rules, insured deposits would have been covered while uninsured balances faced uncertainty. On 12th of March 2023, the government invoked the systemic risk exception. Officials decided following the ordinary playbook could cause panic. The FDIC announced all depositors would be made whole at SVB and Signature Bank. Shareholders were not protected. This decision tells us something important. Depositors were protected because the government chose to go beyond the ordinary line. The FDIC said $16.3 billion of the cost was attributable to protecting uninsured depositors. In other words, the system held by changing gears. Look back to Washington Mutual on 25 September 2008. WAMO was the largest bank failure in history. Yet for many, experience was smooth because JP Morgan acquired the banking operations. ATMs worked, checks cleared. It felt like the train changed tracks without passengers being thrown from their seats. IndyMac showed hard edges. Cyprus showed restricted access. SVB showed that limits may be politically inconvenient to enforce. A bank deposit is a callable promise funded by assets that do not come back on command. The assets behind it often cannot be turned into cash now without pain. That tension is the beam hidden inside the wall. In stress, every weakness shows. If uninsured deposits are large and digitally mobile, the system becomes much more fragile. Uninsured deposits reached 46.6% of the banking system in 2021, the highest share since 1949. Uninsured money is flightier. Social media and mobile banking make runs faster. A rumor used to walk. Now it teleports. The FDIC is a shock absorber, not a force field. It works when one institution fails and others help. It strains when all are dry. Risk is that people misunderstand what they actually bought. They think they bought unlimited certainty. They bought conditional stability. The modern run is no longer a line around the block. It is invisible, living in phones and treasury dashboards. Who gets hurt first is usually the person whose savings have one job and one home. The retired teacher, the pensioner. At IndyMac, people were not speculators. They were ordinary savers. A savings account can become a trap if caution is concentrated. The people least damaged were usually those who did not confuse a bank balance with an unconditional guarantee from reality. Survivor habits, understanding legal structure, separating access risk from loss risk, and being skeptical of yield. Bank safety is not a yes or no question. It is a stack of questions. Solvency, limits, categories, and speed of run. This is historical analysis, not financial advice. Consult a professional. Share this with one person who needs it. Subscribe for more.